Right. So shall we look at the first question? What is the first question? A steady increase in earnings is most likely to be the financial objective of a charity, public listed company, public sector enterprise, and not-profit for company. So what I want to say is a steady increase in earnings is the objective of any of these institutions.
Yes.
Charity need to increase its earnings. Right? Public listed company need to increase it. Public sector enterprise need to increase it. Not-for-profit company need to increase it. But the question is most likely. I mean, but for which institution it is more important?
What, public listed company?
Yeah, right. Yeah. Because for them, I mean, that is, for them it's life and death. Either you make profit or you get out of business. Right? So that is why, so that you can see that the question is most likely is the thing. So most of the questions what I see is, it's almost the answers are, everything is right like, but you have to pick up that keyword and then trace the answer to the keyword.
Okay.
Right. So that's a good one. So let's look at the next one. What are we going to, what is the next one? Let's look at the next one. Yeah. So next one. Which three of the following would be, a public sector college? So again, a public sector. You can see that lot of emphasis on this public, kind of a thing. Public sector college receives government sponsorship for certain courses which teach skills which are needed locally in the form of a fixed fee. Fee for each student completing such courses to a satisfactory level. The college operates within very tight budgetary cash constraints. Now, I want you to understand, even though they are small questions, the total scenario in that question. It is a public sector college which is receiving government sponsored courses with these skills which are needed locally in the form of a fixed fee for each student, completing such courses to a satisfactory level. So, satisfactory level is another word, and it works within a tight budgetary cash constraint. So, which three of the following would be most important in a value for money review of this college by the government? So, the government is going to review it in terms of value for money. Value for money is economy, efficiency, effectiveness.
Okay. So, in terms of money, economy, and efficiency.
Economy, efficiency, effectiveness. That is what we call
effectiveness. Okay.
Yeah, value for money. Economy is you should not waste. Effectiveness is every dollar should be spent on the particular objective, and efficiency is you should not waste. Economy is you should not be overspending.
Okay. Okay. Based on that, I would say cash deficit avoided.
Yeah, very good. Now that is a good start that you took it up. Wherever you find that is that you can answer, you must answer that one. Because in some of these questions, I think you might get for each answer 1 mark, maybe. I don't know.
Okay.
Right? Because, with a 60-mark paper, 100 marks, they may be giving more marks on certain questions. So sometimes when you mark 3, you might get 3 marks. So, for example, where you can find out, write that one straight away. Good find.
Okay.
Cash deficit. Because why do you say that cash deficit avoided? Because you are working on a tight budget, isn't it?
That's right. So, because that is the college operates within a very tight budgetary cash constraint, so they must not go deficit.
Very good.
So, secondly, the number of students enrolled will be important. Because that's value for money. In terms of let me see.
Okay.
Efficiency. I'm not okay. Cost of providing tuition.
I think that is very relevant. Cost of providing tuition is very relevant because that is the economy. It is.
And student achievement level. So I would say the three would be cost of providing tuition, student achievement level, and cash deficit avoidance.
Excellent, excellent. That is what now you will see. Almost all the answers are right again.
Yeah.
But when you try to put up the most important, You did it right, right? You did it right. You took the number of students enrolled, but you said, let me see. Because if they asked for the fourth one, I will put the number of students enrolled. But when it is most important, I think cost of providing tuition becomes more than the number of students involved. Because they get the sponsorship based on the number of students, right? So cost of providing tuition is a very, very important one, economy. And the effectiveness will come from your student achievement level. Good. That's right. That is really good. That is real business kind of analysis what you are doing, which I'm happy. Right. Let's look at the next one. Which of the following best? Again, you can see most, best, that kind of a thing. Which of the following best describe the role of competition authority? Now there, which of the following best describe the role? That means only one answer. Best means one is the one. So you have to be only thinking of one answer. Now you have to look at the answer they are given. To ensure that new business can grow and become successful despite high levels of competition. Number one. To promote fair and ethical competitive behavior. Number two. To prevent monopoly situations developing in essential service industry. To ensure healthy levels of competition and safeguard public interest. So the competition authorities, what will they be looking as the best role?
I think when I went through the questions earlier, I went with the last one.
Okay. Yeah, you're right.
Which is to ensure,
yeah, that's correct. To ensure high levels of competition and safeguard, is it?
Yes.
Yeah, you're right. Because you can see the role of competition authorities to promote fair and ethical best competition, no doubt about it. But the best one is to ensure healthy competition levels and to safeguard the public interest. That is why they are in. That is why they have a role to play about. Good. Yes. Good thinking. Very good.
Okay.
Which three of the following strategies are most likely to enhance shareholder value? Again, you can see the answer the most likely to enhance shareholder value.
The first one, investment in projects.
That is going to, whenever we invest in NPV positive projects, it is going to increase the shareholder value. Very good.
Increasing the rate of dividend growth.
Okay, right.
Let me see. Enhancing brand reputation and recognition, increasing director bonuses. That is certainly not going to increase shareholder value.
What is that?
You increase director bonuses.
Yeah, now that's another good way that you are trying. You are trying to see how to eliminate.
Yeah.
What is not right? Eliminate it here.
Yeah. So moving profitable operations to low tax regimes.
Yeah.
Yes.
It is also going to increase your earnings.
Yeah, so less tax means more money for the shareholder.
That's correct. That's a good thing. Yes. So I think number 1 and number 5 we are almost through. Yes. Now the difference. Now the question is number 3, number 4. We are not going to talk about it. We know it's not right. But we have to decide between increasing the rate of dividend growth and enhancing brand reputation and recognition. What will increase the shareholder wealth?
The dividend is definitely going to increase the shareholder wealth.
Okay.
But gosh.
Yeah, actually, now I'm going to teach you something. This lesson will come up later. But look here, your company makes earnings. Your company makes 100 million earnings, for example, right? Your company decides to pay a dividend. Imagine you are the only shareholder. The company makes 100 million profit. The 100 million belongs to who? After paying taxes?
The ordinary shareholder.
It belongs to the shareholder. Out of that money that is belonging to you, the company decides to pay you 20 million. 20 million. Company is going as a dividend. Is it going to increase your shareholder wealth?
It's going to decrease it, actually.
It is not going to happen anything. What I would think is, look at like this. You are the only shareholder in the company. Assume for a moment, right? Your company makes 100 million profit. You are a director and you are the shareholder. You are making 100 million profit. If you keep that 100 million inside the company, still it is your money.
Okay.
Shareholders'
And if
money.
you take it out,
If you take it out, still it is your money. Only thing it has come out of the company into your pocket. Right? So you will have 20 million in your pocket, 80 million inside the company. Still, both the 100 million is your shareholder base. So what I'm trying, later on we will learn about. What I'm trying to tell you for the moment is declaration of a dividend is not going to increase your shareholder base.
Okay. So I will, yeah. So that's what I was thinking. I said, it doesn't increase your wealth, because whether it's in the company or
it is in the company or it is like if I'm married with, not a good example to put it up, but if I'm married, whether it is in your pocket or husband's pocket, it does not matter. It is the family way.
So enhancing brand reputation and recognition. On the other hand, can have a direct impact on profitability.
Exactly, it is going to increase your earnings.
Shareholder.
Oh, great. Now that is the way that you are going to think it. Right? It is going to increase your earning capacity. What is going to increase the shareholder wealth is the earnings capacity. Declaration of a dividend is something which is only going to transfer that dividend from that pocket to this pocket.
Got you.
Right. So that is, your tree will be investment in projects with NPV positive value, enhances the brand reputation and recognition, moving profitable operations to low tax regimes. All those three is going to increase your earnings. And earnings is the thing that is going to increase the shareholder wealth, not the dividend.
Wealth, not the dividend.
Yeah.
Okay.
So that's great. So that is so this is what we are going to do. We are going to look at questions all the time. Now I'm going to send you some questions for you to do as homework, so that you can send it to me your answers. We can correct it, and that way we will move from now onwards right till the exams.
Fantastic.
Right.
Okay.
So now last time I stopped it. We were on the formulation of financial strategy, but we came to a point and we stopped it.
Sorry.
Yeah.
Sorry, was that only 4 questions or 5?
Well, there. Just a minute. I like it. Did I miss one? Hold on for a second. 4 questions. Yeah, I sent it 4 questions.
Oh, 4. Okay. Right. That's fine.
Right. But now, from now onwards, we will have more questions coming up, because now I have developed certain questions last couple of weeks. So I will be having more questions to send it to you all. But this is what I showed you.
I understand Kaplan has brought out the OT questions kit.
That's right.
I have the E3 one.
Okay. Yeah, I managed to get the P3 one. I did not get the F3 because they are not available here. It's not available here, but it will be available very soon. So we will have those questions also.
Okay.
Even the BPP, I'm sure they will come out. We will have a lot of questions and we are going to look at. So that's a good sign. We are going to see a lot of questions in time to come.
Okay.
Okay, that's great. So last time we were on the formulation of financial strategy. We discussed the 2 decisions, the investment decision and the finance decision, and we stopped it there. I want to pick it up few slides on the dividend decision. Right? That is what last time I think we stopped it. So we will take it up from that one. So dividend decision. So we just now learned how important the dividend decision is. Actually, dividend is not going to increase the shareholder wealth. It is just transferring money from one pocket to the other pocket. But shareholders will expect a dividend. So the directors have to make a decision considering the expectation of the shareholders. And they have to decide how much money they want to keep inside the company for growth. Now the money belongs to the shareholder. Entire profit belongs to the shareholder. If you are going to keep out of that 100 million, 20 million or 80 million, that is also reinvested in the business in the interest of the shareholder. So the company will have to decide how much money they need for reinvestments and how much money they can pay for the shareholder. So, whenever we pay a dividend, it will have a direct impact because that amount of money will not be available for any more investment.
That's right.
And also, when it comes to the dividends, they have to be well aware of what we call debt covenants. When the lenders give you money, they might come to certain agreements with you, saying you cannot pay a dividend until and unless you have a certain ratio, until and unless you have earned X amount of profit. So you have to see, even though there may not be legal barriers, there may be certain covenants which you have agreed, which you have to comply with. So that is also going to have an impact on your dividend decision. You can't ignore. And also, when you pay dividend, it has a kind of a stakeholder conflict, because that amount of dividend that is going to pay is going to reduce the amount that is available for the bonus, etc. for the employee. So, dividend decision is a pure 100% decision of the directors. But now, the UK legislation has brought up the company has to take a vote on the remuneration, not on the dividend, vote on the remuneration. Right? So,
the company has to take a vote on the remuneration? On
the director's remuneration.
Right, a vote.
And the director, if the shareholders vote against, they have to take notice of that one. But so far, not on the dividend. The directors will decide the dividend. Okay?
Oh, so who decides the dividends?
The directors. Directors will decide.
The directors decide the dividend. So who decides the directors' remuneration? The shareholders.
Directors' remuneration is decided earlier by the directors themselves. But now we have something called the remuneration committee sitting and working out the directors' remuneration. But But at the end of the day, they have to give a report to the shareholders, and shareholders will have to vote on the director's remuneration. They will either reject it or they will accept it. So the board will have to take notice of that one. But on the dividends, there is no such thing right at the moment. Dividend. So the dividend decision is purely a decision 100% left with the board of directors. Board of directors. But the shareholders can reduce the dividend.
Okay.
Can reduce. The directors might say we want to pay 50 cents per share. The shareholders can say no, we want to make it 40 cents. But shareholders cannot increase the dividend recommended by the director.
Okay.
They cannot increase. They can only decrease it. Very unlikely that it will happen, but it can happen if the shareholders want it. So these are the decisions that they have to take it very carefully, because it can have an impact upon your investment needs. It can have an impact upon your stakeholder desires. It can have an impact upon the lenders. So the dividend decision will have to be a very balanced decision. The board of directors will have to take it. One of the very, very key decisions that the companies will have to take it. We are going to have one complete chapter on the dividends later. We will look at something more on that. Now I want to talk about the interrelationship between the three key decisions. What are the three key decisions? Investment decision, financing decision, and the dividend decision. So I'm going to look at it. So you have to decide whether you need extra finance. Extra finance for what? For new investment. And what are the consequences of obtaining it? Can I go to the market and get money quickly? If you can get money quickly, you don't need to keep retained funds, because you can always, get the money at any time you want it. Then you have to see whether the shareholders, what they require. Shareholders will get their wealth increased by earning increase. So the shareholders may want dividends or may want capital gain. You remember I told you, right? Yes. You remember I told you the shareholder return comes up in two ways: the dividend per share and the capital gains per share.
And the capital gains per share.
Some directors, some shareholders, they may want a dividend every year. Particularly the old people, they don't want to double up in the share market and capital gains and all that. They want a regular dividend. Some institutions like the pension funds, they want a regular dividend. But some people like to manufacture their dividend and they don't want a dividend, but they will know if the share price goes up, they will sell that number of shares and will make whatever they want. So we have to see what the shareholder expectation is. And then matching of funds. If you need matching of funds means long-term investments must be funded with long-term investment. Long-term investment should be funded with long-term fund. Short-term investments must be funded with short-term funds.
Short-term funds, yeah.
So if you need money for about 2 to 3 months, you should not be thinking of calling shareholder funds for that one. You might as well think of going for a bank overdraft or delaying the dividend by 3 months, for example.
Yeah.
You know that you want some cash in March. So I will wait till March without paying the dividend. I will pay the dividend in April. Dividend payment, dividend decision, dividend date, everything is under the purview of the directors. They can decide. So they have to, the board will have to decide whether they require permanent funding or whether they require short-term funding. Now I am putting up this little chart. There are two kinds of stock exchanges in the UK particularly. London Stock Exchange and what is the other one? Have you got any idea?
AIMS.
Yes, alternative investment market. Yeah, right. AIMS, alternative investment market. So there are two stock exchanges in UK. London Stock Exchange and AIMS. The mature companies, the well-established companies are listed in the London Stock Exchange. The young companies, the growing companies are first listed in the AIMS and after that they will shift to London Stock Exchange later on. So the mature companies are listed in the London Stock Exchange. So the mature company. So the mature company, will you give me a second, Lovette? Hello?
Yes.
Yeah, give me a second. The phone is ringing. I'll come back.
Hello?
The phone is ringing. I'll give you a minute. Yeah.
That's fine. Okay, okay.
Right, sorry.
That's okay.
Okay, so we are now talking about the mature company. Mature companies are the company that is listed in the London Stock Exchange. Now, they are so mature, almost their investment needs are already met, right? They don't need any more investments. And even if they want investments, they are so established, they are so known, they can just go to the market and raise money. Yeah? They can raise money because they are so established, they are so known, everyone knows the people will just jump and invest on those companies. So that is what we call the mature company. And they don't need actual investments because they have already made almost their investment. They probably need a replacement of few assets and all that. They are so established company. So those companies don't need to retain lot of money.
Yeah.
So because of that, they can just pay a high dividend payout. On the other side of it, we had a high growth company, the companies which are growing. They are the companies, the young companies which are listed in the...
They need money.
They need money. And even if they want money, they are not so established, they can't get money from the market or difficult to get it. So therefore, they will retain lot of retained profit. So they probably will have a low dividend or a zero dividend. So considering that one, so the financing decision, so you can see the link between the investment decision and the financing decision and dividend decision. High growth companies, high levels of capital investments, so they need money, right? Mature companies, moderate to lower levels of capital because they have already invested. Financing decision, these people are unable to find debt finance. These people can and they go for high levels of debt finance. Dividend decision, it will be a low or zero dividend against a high dividend payment. So, the shareholder, the potential investor can decide where he wants to invest. If he wants a dividend, he will go and invest in the London Stock Exchange where he can get the dividend. If he's looking for capital growth, he will probably invest in AIM where he can get, no dividend but high capital gain. So that is why in UK we have 2 stock exchanges, and I suppose even in the other countries they must be having something like that, but this is the reason for it. So this is the real relationship in a nice little chart. I put it up for you to understand it. Yeah. Right.
Okay.
So now let's look at what is the next one we have. Influences on financial strategy. Right? Your financial strategy, you are putting up a strategy, but that can be influenced, that can be sometimes we call constraints due to various factors. So one factor will be, you don't want to get extra money due to many reasons, because now you need more money for investment for you to grow. But you don't want to grow because maybe you are a family company and you don't want to lose that control. You don't want to lose that control. So because of that, you don't want to go public. You don't want to take additional investments. So you try to maintain whatever you have it, and that's enough for you. Then some listed companies, one of the big sleepless nights the directors will have is when they decide to go for listing, whether the public will subscribe for the share. It's like election night for the directors, I think. Right? They trouble because they don't know whether the people will subscribe for the shares. If they don't subscribe, it's a very poor
flop.
Yeah, it's a flop, and the reputation, everything is gone. If it is oversubscribed, that is also too bad. That means you have not decided on the right price, and that can have an impact upon your existing shareholder. So for all those reasons, particularly if the market is very dull, the directors might decide, okay, we are not going to go for the new public listing or the new share issue. And that can have an impact on your financial strategy ultimately. Right? Some directors, particularly the people who are risk-averse people, they may be scared to take debt money, thinking that they will be unable to service the debt. That can have an impact upon your financial strategy. Tax shields. Now, interest is something tax deductible. So most of the companies would like to borrow money and pay interest because they can deduct that as an expenditure. But in certain companies, there may be tax holidays, right? A tax holiday given by the government, or maybe that the company has made losses and therefore there is no need to pay taxes for next 3 to 4 years. In that case, your strategy will change because there is no gain that you can get by borrowing money, because there is no tax deductibility for the interest. So your strategy may change. For example, both of us signed 2 companies. Your company is paying taxes, my company is not paying taxes. So I have no clear advantage to go for borrowing because there is nothing for me to deduct it. So my strategy will be different from your strategy. Right?
Okay.
Then when you go for borrowing, the banks will ask for a lot of security, the collateral. You may not have enough collateral, and therefore you will decide that's enough, we can't borrow anymore, and therefore let's stop our investment levels at this stage, let's stop our growth at this level. And some companies, they want to maintain their credit rating, triple A's, double A's, all that kind of thing. So they might, even though they find a good opportunity, they might think, okay, if I borrow more money, my credit rating may come down, my credit rating can have an impact, so therefore let's not borrow, let's not do anything more than this, let's be happy with what we are doing. So any one of these reasons can have an influence on your financial strategy. Investor relationship. Now your existing shareholders probably will not like for you to come out with any more new shares, right? Because that is going to eat into their profit, or their earnings per share can come down at least immediately. So you want to maintain your investor relationship. You want to maintain good relationship with your present investor. And therefore you might decide not to go for a new share issue. Agency theory. What is agency theory? Agency theory is the relationship between one relationship between the shareholders and the director.
And the directors.
Yes. The director is the agent, shareholder is the principal. Right? Now, the agent generally, whoever the agent generally looks after himself before he looks after the principal. He is doing business for his agency commission. Right? If you give a real property to be sold to one of the estate real agents, he will decide whether to sell your property or my property depending on how much he is going to get. And similarly, the directors also will work out on that kind of a thing, what they call the agency theory. So they might decide we want a bigger bonus, and because of that reason they might not declare a good dividend, and that can have an impact on your financial strategy. Business strategy conflicts. There can be lot of conflicts like cultural things. Right now, I am working for a company, or rather, I am working for a company all this time where the owner is a Muslim. So their belief is totally different from what I teach you. Right? For them, it's a sin for them to borrow money and pay interest. So even though I'm teaching that the lending is the borrowing is good and all that, in that company I could not practice any of those things because there was a culture conflict, because the religious conflict. So the cost of finance was more, and we had to pay bigger amounts, but that was the way that they want to operate because they don't want to pay any interest. So there can be a lot of business strategy conflict. Certain areas of business you don't want to pursue. Maybe your personal moral values, religious values can come and hamper it. In Sri Lanka, I see a lot of youngsters, they don't want even to join a company that is manufacturing this tobacco or liquor or whatever it may be. Right? So people have their different perceptions, cultures, so that can have regulatory influences, external regulatory influences. The regulator can come and put up lot of, you decide a price, but the regulator says, no, Lovette, you can't sell it over this price. You decide on the quality. The regulator says, no, that quality is not good. Unless this quality is given, you can't do it. You want to acquire another company, the regulator says, no, in the interest of healthy competition, we are not allowing you to acquire it. So your financial strategy is stopped. Yeah?
Yeah. So these are all very big influences on the financial strategy of companies.
Yeah.
Therefore, it means that in writing your financial strategy, you have to look at each and every one of these topics.
You're right. Because I mean, at least in general, you must know in a particular scenario, particularly in the strategic case study, there may be certain indications that the directors are not in agreement to do this kind of a business. That we have to respect their view, and then we have to agree. Yes, it cannot be. I remember that when I joined this company about 10 years back, when I was given the letter of appointment, for a moment I got a shock. It said, no, I'm the finance director, I'm given a letter of appointment as the director of finance, but it says, you are not supposed to borrow a single rupee and pay any interest. For a moment, because I came from a public sector institution, I was borrowing money like nothing, and my skills were in negotiating the best terms with the government and the Foreign World Bank and the Asian Development Bank and all that. And suddenly I come to a place where they say you are prohibited, strictly prohibited from borrowing any money. so for a moment I was thinking, my skills all gone. Actually, honestly, my skills went off truly because my skills were.
So how did they? Okay, I've never really found out, because how do they do it? Muslim companies, how do they raise finance?
Yeah, they raise finance on what they call a Sharia law. The bank.
What does that say?
Yeah, the banker who gives, they come into a profit sharing scheme. With their money, whatever we do, we have to give them a 14% or 15%. I mean, it's like interest, but only thing is, if you don't make a profit, you don't need to pay them. They can't come and force you. Interest, if you borrow it, you have to pay whether you make a profit or not. But this is on a particular transaction, they will give you money. If you make a profit, you have to give their share. If you don't make a profit, you can just say, just keep quiet. But costly, but very costly, because normally if I can borrow it at 8%, they will charge 15%, for example, right? Because they also take a big risk. That is what the Islamic. So the SIMA has introduced Islamic finance banking as a separate subject, but so far they are not put it into our curriculum. But there's a subject called Islamic funding, which is a very interesting area. How they work it out, because this Islamic business is growing all over, and they have a very fear that if they do anything now. Our company collapsed recently. Of course, with all the things we had to, not that we had to borrow certain money which we took it on that kind of a thing, we could not pay, and ultimately the supplier started charging interest. So whether like it or not, we had to pay interest. And my managing director was telling, this is the curse that we are having. For them, it's a big curse. It's a big curse. So last week or 2 weeks back, there was one of the other directors suggesting that we give 30 days extra credit for some of the customers where we can make big money. But to fund that 30 days extra credit, why don't we go and negotiate with the bank and get a facility? So I saw my managing director writing in red letters. Probably he was very angry. He was writing in big red bold letters and telling the other directors, "Are you suggesting to pay interest? Do you want that curse to come back? I'm not in agreement." So very interesting. Very interesting. This board of directors. One man from one religious background, another man from that religious background.
Oh my gosh.
This is real board of directors.
Hello? Can you hear me?
Yeah, yes.
I hope I have not lost you.
No. I can hear you. This is real, the way that the boards are working. So the regulatory influences can come up. Corporate governance can restrict your strategy or determine your strategy. Like you want to do business on ethical, moral grounds, competitive grounds, ethically you have to do it. You want to do with social responsibility. That means you're going to spend some money. So that is also can have an influence on your financial strategy. Then as I said, the industry regulators, the competitive regulation, all these things can have an impact upon your strategy. Yeah. So
that's right.
Yeah. So the business, so what I'm trying to tell you is that, when you're in business, when you're talking about financial strategy, you have to think of each and every one of all these things, because each and every one is going to have an impact upon. Then the sensitivity of attainment into economic factors. So your financial objectives, whatever the objectives that you have set aside, can be influenced by certain economic factors. The three key economic factors are the interest rate, the inflation rate, and the exchange rate. All what you decide can be influenced by interest rate. If the interest rates goes up, right, the companies will start reducing the borrowings because they may not be able to pay that high cost of finance. And that will reduce your growth because you are not going to invest, because you are not going to borrow big money. And the companies with surplus cash, rather than investing in their business, they might think of investment in some other place to get interest. So when the interest rate goes up, generally the businesses will start coming down in growth and the strategies can be affected. And also the interest rate is somewhat a guide for the return that the shareholders want. Because if the...
How?
Yeah, now say for your money, the bank is paying you, shall we say, 6% interest. You can just put your money in the bank, sleep peacefully, and you can get a 6% interest. But if you are going to invest that money in a business, you probably will need more than 6%. Why? Because there's a risk factor.
That's right.
Risk factor. So the general interest rate will decide, okay, this plus so much I want is 4%, for example. So the return on investment will be 10%. Now, for example, a country like Sri Lanka, our interest rates are something like 12%. So if you want to invest in Sri Lanka, you will reach probably 12 plus 6, maybe 18%. Whereas in UK, you will be happy to get about 10%. So what I'm trying to say is you can't compare the UK and Sri Lanka without considering the interest rate. So interest rates generally decide what the shareholders want. What about inflation? What happens with inflation? With inflation, the cost of production goes up. Selling price goes up. And with all that, what is going to happen? It will have a factor on your demand. Demand can come down, right?
Disposable incomes will reduce.
Yeah, that's right. Disposable income will reduce, and therefore the demand for the goods will come down, and therefore the economy. We just had a change of government 3 days back, and today the new government, the cabinet is taking up those, and with the business sector has already taken up some signaling effect, and the share market has gone up because they believe the new government will reduce the inflation, will give them reduced interest rates, and that probably the business will go up in line. Because the new prime minister is somewhat an open economic man, so the people have a lot of hopes that things are going to change.
Okay.
Yeah. Then you are expert on the currency, right? The currency also will have an impact upon your business. If your home currency is going to depreciate, and if you are going to import a lot of products from a foreign country, the cost will go up, right? So all those factors. Now, my company. Sorry.
Could you move the slide up a bit so I can see there's some parts of it are
yeah. Just a minute. I think something. Yeah, hold on for a second. I think I should be able to see that one. Hold on. Yeah. Sorry.
Yeah.
Okay. When currency appreciates, it will increase cost of exports, decrease cost of imports. And the opposite happens. When the currency depreciates, it will decrease the cost of exports, increase the cost of import. So it has an impact. Your currency rate will have an impact on your business strategy. Now, I'm a company that is importing a lot of products. So when my home currency depreciates, the cost goes up, and that is having an impact on your market selling price and the demand for the product. Yeah? So you can see it's a financial strategy. That is why you can see a lot of people have a lot of plans, but not that every plan can come right. There can be many other things beyond our controls having an impact upon us and not having up. So this is what we need to know. Right. Then international influences on the strategy. Now, I think you know this one very well. The international influences, right? But the company is dealing with globally in another country. The foreign exchange rate surely is going to have an impact. There can be political risk because the other country can put certain restrictions on you, certain adverse conditions on you that can have an impact. The management control is going to be very tough because it's not like you operating from your home country. You are in another, right, trying to operate it too, even with the internet or Skype or whatever it may be, not so easy as you see the things on eye to eye. Cultural differences, the language barriers, time zone differences, right, and also the litigation and regulatory issues. All these things can have an impact upon your strategy. So particularly when you are doing international business, you have to be very much focused on the other governments. I'm sure the whole world is watching the Sri Lanka little country today to see who are the people going to be appointed as the ministers and what kind of a policy these people are going to have, because Sri Lanka is attracting a lot of foreign investment. So surely last 3 months we did not have anything happening because people are waiting for this change, and now people probably globally, because I saw the UK Prime Minister congratulating the President, the American President congratulating the President. So there will be a lot of changes happening in Sri Lanka economy. And that is very important for the business people. Your litigation.
Same thing is going to be happening in Nigeria because they've just finished the primaries. The elections are going to start next month.
All right.
That's February and March are the elections.
Yeah.
You know, in Nigeria. So businesses are also watching the country closely now.
That's correct. Yeah, because now this 1 or 2 months you will see nothing happening in Nigeria. People will watch to see what is the government going to be and what the government policies are going to be. So international business, we have to be very, very thorough with every government, everything what's happening around. Yeah.
Yeah.
So then the multinationals. Who are the multinationals? Multinational is basically where we are going to the two key words that I want to learn from this slide. The multinational, either they own or control production facilities in another country. So just because you are doing business with a foreign country, you are not a multinational. Either you must own or you must control. So if you come to Sri Lanka and own a company, then you become a multinational. If you come to Sri Lanka and control the company, you become a multinational. Otherwise, if from UK, if you are going to do business with Sri Lanka, you are not a multinational. So just by importing and exporting, you are not a multinational. And in a multinational, the strategy is going to be totally different from the normal company. Because they are so large, they have lot of tax advantages which they can come. And their strategy, their thinking will be totally different from a normal company. Because they may take in certain area. Now, for example, they might invest in Sri Lanka, where the gearing is going to be 55%. Now, if you and I are going to invest, 55% is too big figure and we will raise our item. But a multinational may take 55% because they are a big organization in the world. Overall, their gearing may be still 30%. So, they will think of taxes, gearing, the size and the complexity, all that when they want to consider. Yeah?
Yeah.
So that is something the multinationals have an advantage over the others. And that is why most of the people don't like multinationals also. Because they can always exploit you. So, another one which I not put a slide, but I'll later on I'll send you a kind of a thing. It is the taxes can have an impact upon your strategy. Most of the companies are shifting to low tax regimes where the double taxation rates are available. Your production facilities are shifted because there you can have a different thing altogether.
That's right.
So that with that we are finishing up with our financial strategy area. Formulation of financial strategy. So now I want to start on the new area which we call the performance analysis. Performance analysis.
Okay.
So this is what we are going to look at. This is basically the ratios and all that kind of a thing. So now whether you are an investor, already invested the money, or whether you have a lot of money and if you want to invest, before you invest, you probably want to have a good look at the company where you're going to invest, their performance.
Yeah.
And one document that you have in your hand is what? Your annual report. But the annual report gives your financial statement and historical ones. It is not really good enough for you to do a good analysis to decide to whether to invest or not. So for that purpose, we have to do something that we call a performance evaluation. The potential investors will do, existing investors will do, not only the investors, even the employees will do, unions will do, not only the unions, even the management will do to see whether they are on the right track or not. And the tool that they use to do all these things is what we call ratios.
Okay.
So once once the objectives are decided, that's 4 types of ratios. When the objectives are decided, right, when a company decides, the company itself will have to decide or to evaluate whether they are going to achieve the objective or whether they have achieved the objective. And the objectives are generally spelled out in terms of ratios or some appraisal price. So the impact on your financial decision. So this is basically through ratio analysis. So the ratios becomes meaningful only if it can be compared with. If you tell that your return on capital employed is 25%, it does not make any sense unless it can be compared with something. So with what can you compare? The ratios become meaningful. Pardon?
Similar companies,
similar companies you can compare. You can compare with your own company the previous years.
Previous history.
You can compare with the budget, right? You have put up a budget to see whether you are achieving the objectives or not. You can compare with the budget, right? And you can compare with the industry. So the comparison could be between past periods, against budget, between divisions, or between industry firms. And once the comparison is done, this is very important, that is not the end. It is just the idea you get. For example, two our companies, your company in UK and my company in Sri Lanka, we might compare and say the return on capital employed, your company is 15%, my company is 20%. Now, no one can come to a conclusion and say my company is better. It will depend on many other factors. What are the Sri Lankan interest rate? Right? What are the Sri Lankan cost of finance? All that factors. So you have to do a further evaluation. This is where your skills will come up on the interpretation and analysis. And I'm sure this is some area that our people who are the strategic case study will be impacting upon. So you must compare oranges with oranges, apples with apples, not oranges and apples. So that is what very important. When you are comparing the ratios, you have to be very, very careful. You bring them to the same platform before you try to interpret the result. Otherwise, you get into a very, very poor interpreter if you try to compare the apples and oranges and give an interpretation. Now, that is what your skills are going to be. So, who are the people who are going to use these ratios? Right? The ratios are used by many people. Investors, surely. Investors, the existing investors, the potential investors, all the people. The investors will be very much concerned about the return. So they will be concerned on certain ratios if we are going to look at dividend payout, gearing, price earnings ratio, all that kind of thing. Lenders, the people who give money, they will be concerned. The interest cover particularly, how much safe they are on them getting the interest. Right? So the cash flow, whether they are making a positive cash flow or a negative cash flow, the gearing, management. Management, I think, is more concerned about the ratios. What is our receivable
of the business?
Yeah, right. They are the key driving factors. How is our liquidity? Right? What is our receivable days? What is our inventory days? What is our GP margin? Is it increasing, decreasing? And why? All that need to be discussed. Suppliers to a lesser extent, but surely they also will be interested. If they are big key suppliers, they will be wanting to know the liquidity, etc., etc. So many users. Having said that,
they want to know if they will be paid on time.
Having said that the ratios are very important, it has its own limitations, right? So the limitations, so it has some lock slide. Because the information, the comparable information. Now you said earlier, two companies can be compared, but do you have all the information to compare? We might get the annual report. Almost difficult. We might get the annual report, but how do we know that they are prepared in the same basis as what we prepared? And also, it is history. It's lot of information is history. History may be out of date. You have got a new set of board of directors. Now today, if you look at Sri Lanka, we have got a new government. So we can't compare last year with the current year. Right? You
can't assume that
things
are going to continue in the same way.
Exactly, you're right.
Have been in the last 5 years.
Exactly. So you have to take those factors into account when making your recommendations or whatever it may be. You could have got a new CEO, a very dynamic man, but you had an old man who was, who didn't do anything. So now you can't compare that company as who don't invest in that company. You have to consider the new factors. So historical information may be relevant, right? But careful interpretation of accounting policies, because accounting policies can distort your ratios. You may be providing depreciation on historical cost basis. I may be providing depreciation on revaluation basis. It can have an impact.
Historical information may be relevant where the management, there has been no changes or no planned sudden changes in management.
Yeah.
Or in the environment.
Yes, environment changes, political changes, all that can have an impact. Ratios, there can be accounting loopholes. You remember a lot of time we had this loophole on this the leasing, right? Operating lease and financial lease. So it's a matter of, how you are going to say whether it's a financial lease or operating lease. Two accounting treatment. Financial lease, you have to bring the asset, you have to bring the liability into the account. Operating lease, it is not there. So two companies can prepare the financial statements in two ways, and that can. Remember, these are the things that what happened in the Enron, right? They prepare the financial statements, manipulating their own thing. So the ratios is a good thing, but remember, it has its own limitation.
That's right. Okay.
So the four categories of ratios: profitability and return, debt and gearing, liquidity ratios, and shareholder stock market ratios.
And shareholder stock ratios.
These are the four kinds of ratios we are going to learn, and we will be looking some more details of these ratios. So I'm going to look at the profitability ratios. One of the profitability ratios is return on capital employed. What is return on capital employed? Now, I remember you told me that you want some ways to remember these things, right? So return on capital employed. Yeah. What is return on capital employed? Now, who is giving you the capital? Who is giving you
the shareholders or debt or lenders?
Both are giving you the capital, isn't it?
Yes.
The lenders and the shareholders are giving you the capital. So the total capital is made up of equity capital plus the liabilities. And therefore, what you have to consider is the return, the profit before interest and taxes. Right? Because that is the profit, that is belonging to both those categories. So if you are going to look at the return on capital employed is both those people, capital, and therefore it should be profit before interest and taxes.
Okay.
So, and that is going to tell you, so when you say the return on capital employed is 20%, but it's telling is for every $100 that I've invested, I'm getting $20 as my return. Whether it is good or bad, I don't know. It all depends on what my competitor is going to do, what I did last year and what my budget was. Then the next one is return on equity. Return on equity. Equity is the people who have given you equity money. What is left for them? What is the return for them? It is the profit after interest and taxes. It is the profit
slash value of equity.
Yeah.
After the interest and taxes, okay.
Yeah, because that is the earnings. That is what we call earnings.
The interest doesn't belong to the equity. The interest is for the lenders.
Interest is for the lenders. So after paying interest, after paying taxes, the residual income is what we call the earnings, and that belongs to the
profit from operations. So basically, the profit from operations.
Not really profit from operation. Profit from operations is before interest and taxes.
It's before interest
and taxes. And then after that you pay taxes, then you come to profit before tax, then you pay the taxes, then you arrive at what we call profit after tax. And that is what we call earnings. That is what we call earnings. And that belongs to you, the shareholder. And that must be compared with your equity value. So the equity value, it can be a book value of equity. Equity book value is your share capital plus reserves. Share capital plus reserves. So that is the way that you calculate the equity value, share capital plus reserves. If you remember your F2 time, you would have been doing the net assets, it's the share capital plus reserves. That is the wealth of the shareholder. The share capital belongs to the shareholder, the reserves belongs to the shareholder. So on that, how much are they earning? That is what we call return on equity. But sometimes the examiner will tell you to calculate the return on equity based on market value. What is the market value? The market value of equity. Now this can be only done for a listed company. Only for a listed company. The listed company, the market value of equity is number of shares in the market multiplied by the market price per share. So if you have 10 million shares and the market price per share is $5, your market value of equity is 50 million. So that is one way to calculate the value of equity. You don't take the reserves, you take the number of shares into the market value. But this is available only for a listed company. Why? Because the unlisted company, they don't have a market value. So the unlisted company, only way to value with the return on equity is book value, that is share capital.
Sorry, quick question.
Yeah, sure.
How do you interpret market cap?
Sorry, market the same. Market capitalization is this one. Market capitalization is market value of equity. Number of shares into the market price per share. This is called market capitalization.
That's the term I'm used to.
Yeah, right, you're right. That is what we call the market capitalization. Market capitalization. Okay. So the market capitalization is number of shares into the market price per share. And that can change almost every day. Market capitalization. So that is available only for a listed company. So normally in the if they talk about a listed company, generally we would go with the market value of equity to calculate even the return on equity. But if it is an unlisted company, we don't have a market value, so we have to go by the share capital plus the risk book value. Right? Then what is profit margin? Profit margin. Profit margin is profit before interest and taxes divided by your revenue. Profit before interest and taxes divided by your revenue. So you remember your what is this income statement? You get the revenue, say shall we say 100 million, then cost of sales shall we say 60 million, then you get a 40 million, that is what we call gross profit. Then we have establishment, selling, distribution expenses, shall we say 15 million, 25. Then we have, this is what we call operational profit. Then shall we say interest, we have paid 5 million, so 20 million. This is what we call profit before tax, right? And then from there we have to pay, say, shall we say taxes 7 million. The balance is profit after tax, which we call earnings.
Right.
So yeah, PBT. PAT. So profit before tax. Profit before tax, after the profit before tax is what we call the profit margin. Profit before interest and revenue. That is what we call operational profit. So operational profit is, in this case, 25 million against the divided by revenue of 100 million. As a percentage, it is 25%. So what is it telling you? It is telling you for every $100 of revenue, we get a profit margin of $25. We get a profit margin of $25. What is the gross profit in this scenario? What I have put it up. Gross profit is gross profit divided by revenue. So gross profit is 40 here divided by revenue. As a percentage, we call it 40%. Right? 40%. So gross profit is 40% margin. The net profit margin is 25%. What does that mean? 15% we have spent on our expenses. For every $100, I earned 40 gross profit, but out of that I spent 15 and I've ended up with a 25 profit margin. So any company should be trying to increase this profit margin. How to increase the profit margin? What have we got to do to increase the profit margin?
Well, they can increase sales, so revenue, if revenues are high, and reduce costs. Reduce
cost. Yeah, either must increase the selling price, right? Selling price. It's not the volumes that is really going to bring you, it is the selling price, or you must reduce the cost per unit. Because for every $100, you are going to spend $80 in this case, $75. So if you can make it $70, you are okay. So basically this ratio will tell us about how good your cost controls are. How good your cost controls, right? Two companies say your company is making a 25% profit margin, my company is making 20% profit margin. So it tells us that my company is not doing so well on cost controls. The next ratio is the asset turnover. That is revenue divided by capital employed. So it tells us for each $100 of capital employed, how much revenue we are generating. Each $100 of capital employed, how much revenue we are generating. So maybe we are generating $200, maybe we are generating $300. Now that is also ratio we should try and increase. That tells us how good we are on our capital utilization. If I can have $100 and earn $200, and if you are going to with your $100, if you are going to earn only $150, surely you are not using your assets as much as well as I am. Maybe you have more idle assets. Maybe you have some obsolete assets, whatever it may be. So that is why this asset turnover ratio is a very, very important ratio. Normally it is not given as a percentage, it is given as more of a ratio. So your revenue is 200 million, capital is shall we say 500 million. So this is given as a ratio 2:5. Right? So this is what this ratio will tell us. Now I want to show you a relationship, probably maybe that you knew or you did not know about it, but I'm going to show you a relationship between these ratios. So I'm going to mark these ratios 1, not that one, that is not important for me, 1, 2, 3 and 4. Right? 1, 2, 3 and 4. So I want to look at the ratio number 2, profit margin. Profit margin is profit before interest and taxes divided by revenue. Right? Ratio number 2. Ratio number 2. Ratio number 3, asset turnover. Asset turnover is revenue divided by capital employed. Right? Revenue divided by revenue. Asset turnover. Revenue divided by capital employed.
Capital employed. CE.
Yeah, CO. Now, so now look at this ratio. The line number 5 I have put it up. So with this one, my revenue and revenue will get cancelled out. Correct?
Yeah.
What I'm left with? What am I left with? Profit before interest and tax divided by capital employed. What is that ratio? What is that ratio? That is what?
That's your gross.
Ratio number 1. Is it?
Yeah.
Can you see? Can you see the ratio number 1?
Yes.
So ratio number 1 is made up of 2 ratios. Ratio number 2 and 3. This is what Miss number 4 is telling me. Ratio number 1, return on capital employed, is made up of profit margin and asset turnover. So you as a company, I as a company, we surely want to increase our return on capital employed. How can I increase it? Either I can increase by increasing the profit margin, or I can increase by increasing the asset turnover, or by both. Do you get the point? So the return on capital employed is a function of profit margin and asset turnover. So every company is interested in increasing the return on capital. So I can increase the return on capital by increasing the profit margin, or by increasing the asset turnover, or by increasing both. Right?
Okay, I have to look at that again.
Yeah, just.
I had been.
Yeah, yes. Hey, don't worry. Right. What I'm saying is, look at the ratios 1, 2, 3 and 4. So first I did was I took the ratio number 2, profit before interest and taxes divided by revenue. Then I took the ratio number 3, revenue divided by capital employed. So I cancel the revenue to revenue. So I get profit before interest and taxes divided by capital employed. and that is your ROC. So ROC is made up of two ratios, ratio number 2 and ratio number 3. So if you want to increase your ROC, you can increase the ROC by increasing the ratio number 2. Or you can increase the ROC by increasing ratio number 3. Or by both. So if you are interested in capital and the return on capital employed going up, which is I'm sure your interest, you should try and increase the profit margin. How to increase the profit margin? You must have good cost controls. Good cost controls. How to improve the asset turnover? Proper utilization of assets. So that is why you should not have any unwanted assets, all that kind of thing. You must be proper utilization of assets. If you do that, you will improve your return on capital. Now, rising from this, you can see another very important one, right? You can have the same return on capital employed. Two companies, company A, company B, can have the same return on capital employed, but for two good reasons. So let's assume 25% is the return on capital of company A and company B yours. 25%. It may be arising your profit margin in this company may be 20% profit margin, and your asset turnover may be how much? 1.25%. 1.25%. So if you multiply 20 by 1.25%, how much are you getting?
About 25.
Yeah, that's correct. So that's what I'm trying to tell you. So this company A, is making this 25% by having a profit margin of 20% and not a percentage, as a ratio asset turnover 1.25. That means your assets are getting turned over 1.25 times. That is what it means. Assets are getting turned over 1.25 times. Now, the other...
What is the desirable? The higher the better, of course.
Yeah, higher the better, of course, always. It depends from one country to the other, one company to the other company. But
is that a level that is industry level that is accepted?
Different companies will have a different level. Now, for example, if you look at a consultancy firm like what you are doing, you are not going to have too much of assets.
No.
You are going to not have too much of. So your return on capital employed will have to be very much higher than a manufacturing company. So you can't compare a manufacturing company and your consultancy company and say, oh my God, I'm getting high 75% return on capital employed. I'm doing better than such and such company.
Yeah.
So generally, the desirable rate is the return that the investors will expect. Return that the investors will expect. So that will all depend on your interest rates of the country and many other factors like the risk factor and everything. So for example, the company A, this is the scenario. Let's look at the company B. Company B, maybe their profit margin is 12%, but their asset turnover is 2.2% or something like 2.2 times. So now you can see what is going to happen for them. Yeah, the asset turnover is 2.2 or something like that, 2.08. So you will again see the 25% return. But both the companies are making the same 25%, but for two reasons. This company is doing very well. The company B is doing very well on asset turnover. They are turning it 2.2 times. Whereas the other company A, is doing very well on their profit margin, the cost control. They are spending only 80, whereas these people are spending 88 for the point, right? So you can have the same return on capital, but for two reasons. One company doing better on asset turnover, one company doing better on ROC. But as a managing director of a company, as a CEO of a company, you must try to improve your profit margin, you must try to improve your asset turnover, then obviously your ROC will go up. Yeah. So that is what you should be trying.
So you Could you say that again? As a company director, you must
as a company director, you should be trying to increase your profit margin all the time. That is
margins.
Good,
yes.
good cost controls, good cost control, and also you must improve your asset turnover, proper utilization of assets, proper utilization of assets. So that is why you must have the minimum assets, maximum revenue. Don't have unwanted assets. Don't have excess inventory. Don't have excess money tied up on debtors. Don't have excess money on unwanted property, plant and equipment. If you can improve on both these things, you are going to improve your return on capital. This is what we call the profitability ratio. Clear? So this is
return on capital employed.
Return on capital employed. This is a big measurement. All the companies are looking for the ROC all the time. So the ROC is made up, very importantly, asset turnover and the profit margin. Profit margin and asset turnover.
And the profit margin.
Yeah.
Okay.
Right.
Okay.
So in interpreting the ratios, you have to look at factors like the risk factor. Higher the risk, you will expect a higher return. Right? So your company and my company cannot be considered because your company may be doing some risky business. The investor will expect a higher ROC.
Yeah.
Then the capital intensity. You are doing consultancy company. The investor will expect you obviously a higher return than me because I am in manufacturing. I need property, plant and equipment. You don't need all that. Now for me to give my distribution thing, I need only the laptop and the headphone and little things. I don't have too much of capital. I think if you look at the INSEP, those fellows may not be having any capital at all. Right? But they are making a lot of money. Right? So they use the intellectual knowledge of the people and do it. Look at lawyers. They don't have any capital item, but they make a lot of money. Yeah. So also when you are interpreting the ratio, you must look at the industry average. Now industry averages also is you have to be very careful. Now for example, return on capital employed, for example, the industry average, that means all the firms together may be earning 20%. All the firms together is earning 20%. That is what we call the industry average. Your firm, your company X is making 24% return. Now what can you say looking at these two figures? The industry's average is 20%, but your firm is making 24%. What can you say?
Well, on the look of it, it looks like your company is doing above industry average.
Yeah, company.
You have to also bear, yeah, you have to also bear in mind that the industry average could have wide variation.
Oh, that's excellent. That is what I was trying to explain it. You have already explained it. Because when you say 20%, there can be people who are earning 28, there can be people who are earning 26, and there can be at the low end people who are earning 15%. And that is how the average is made up 20%. So just because I'm earning 24%, it does not necessarily mean I'm the Superman. There may be better Superman than me, 28 and 26 fellows. But I'm surely doing better than the industry average.
Yeah.
So that is what the interpretation needs. Right? Just because you are doing better than the industry, don't think that you are the Superman. And the return on capital employed, when you are interpreting, we must interpret it along with the interest rates of the country. In Sri Lanka, the interest rates are 12%. So our return on capital employed will have to be always above 12%. Otherwise, people will not invest. But in UK, interest rates may be 6%. So there, the return on capital can be anything above 6%. It need not be 12%. Yeah. So these are the factors that you have to consider when you are making the investment.
Okay. Now, how do you measure risk factor?
Yeah.
Is there a measure, a ratio?
No, there is no risk factor measurement in a ratio. There is something called value at risk, something which we will discuss it in a P3, a value at risk that is mostly for the financial institution. That is, you try to see, at a certain level of confidence, how much risk is there in your day-to-day business. But the risk is not something that we really have a kind of a calculation. but we can talk in terms of probability, 50% probability of something happening, 30% probability of something happening, and with that we calculate something called expected value. But no standard ratio like what we can see here.
Okay.
So that is one type of ratios we are going to look at. So the issues to be noted, the revaluations. Now, for example, you might find your company did not do a revaluation. So your capital employed will be very much less. I have done a revaluation last year, right? So now my capital employed is more, but it does not mean that anything has changed. It's only purely a book entry that has changed. So I can't compare even myself with last year and this year and say anything about it. For example, I made a profit of, shall we say, this year 25 million profit before tax, before interest and tax, and my capital employed was 100 million. So my ROC will be 25%.
Hello?
Hello? Hello? Hello? Yeah, can you hear me? Hi, hello? Hello?
Hello? Okay.
Yeah, can you hear me?
I can hear you now.
Right, okay.
So what happened?
Right, okay. Right. So what I was trying to tell you was, look at one company, Lovette, which has a 25 million profit before interest and tax, and they have made their capital investment is 100 million. So they will report a ROC of 25%. Next year, they revalue the assets. Once you revalue the assets, what happens? Your property, plant and equipment, yeah?
It goes down because of depreciation, Bobby.
Yeah.
Or is that what you mean?
No, yeah, that's right. Normally it goes down depreciation, but you revalue. Revalue means you see the market value of the asset. Earlier the market value was, earlier the book value was 30 million, but now the market value is 50 million. You bring it up.
So you beef it up. Okay, revaluation means that you actually, okay.
You increase the value.
Okay, boosts the value of your assets. Okay, fine. Okay.
When the value of the asset goes up, what happens? Your reserves also will go up. What you do is you increase the value of the asset, and the value of the reserves will go up. So let's assume by 20 million it goes up, and let's assume the next year also the company makes the same profit of 25 million, and now the new assets are value of the capital employed is not 100, 120. Now what is going to happen to your ROC?
It's going to go down.
It's going to go down. But are we comparing apples with apples here?
Yes.
Are we comparing apples with apples? No. Because last year this was historical cost. This year it is revaluation. So two different accounting bases. You understand?
Sorry.
Sorry.
Am I following you properly?
Yeah, okay. Last year we made a profit of 25 million. My assets are valued at historical cost, that is at real cost 100 million. So I said my return on capital employed is 25%. This year, same profit I made, but I revalued my assets from 30 to 50, and therefore my capital employed went up from 100 to 120. So it's a new basis. Earlier historical cost, but now my capital employed is on revaluation basis, and therefore my return on capital employed has come down. What I'm asking is these two comparable? Is these two comparable? I say no. I say no. Why do I say no?
I think because the value of the two companies' assets is different, because you have two different values for your assets.
Two basis of valuation.
The basis of valuation.
Then it's different. Actually, I took the same company, two different years.
Yeah.
But you can see one year I went on historical cost. Second year I gone on revaluation. So now for me to say return on capital has come down is not right. In fact, if I put it up on the right valuation, the return on capital is same. Either I must bring the last year also to revaluation, or either I must bring this year to the historical cost. I must use the same base. Otherwise, my ratios are irrelevant, meaningful, misleading. So this is something which we need to do in when you are looking at the ratios. So the revaluations can have an impact on your accounting policy on goodwill, research and development expenditure. Now, where are you putting your research and development expenses? Some companies, they might write off. Some companies, they might capitalize. So that will have an impact upon comparison of companies. Then you remember, you said the capital is made up of equity and loans.
And
loans, isn't it?
Loans, yes.
Yeah. Because the loans is something where we pay interest, and that is why we took profit before interest and taxes as our return figure.
Yeah.
Now you might find some overdraft. Overdrafts are where they normally in the balance sheet. Where is it? It is under current liability. Current liability. But that also sometimes you might want to consider that as capital employed, because the loans plus overdraft. Some companies might consider like that. Some companies might think overdraft is a very temporary one, and therefore we should not consider. So depending on how you are going to look at, it can have an impact upon it.
Yeah, especially with that OD is high.
Yeah, especially if the OD is high, especially if the OD is a permanent OD. In that case, I think the right thing is to treat it as a capital expenditure, to treat it as a loan, because it's a permanent OD. Even though we show it as a current liability, it's a permanent capital. In that case, right thing is to consider that also as your capital employed. But if it's overdraft that is just there for 2 weeks, 3 weeks, 4 weeks, then you might as well ignore it. But what I'm trying to say is, same basis must be applied. If you are taking the overdraft last year, take this year's overdraft. Otherwise, you are not. This is where you have to be careful, because some of these accountants are very smart fellows. 1 year they will do with one, next year they will do with another, and they will try to say, oh, we are doing this thing, that thing, all that. Got it. Right. So we have some more ratios to discuss, but we are going to stop it here today, and we will look at the balance ratios and the balance part of it when we meet next time.
Okay.
Right. So what I want is, I will send you the note on, I will send you the recording up to this point. I want you to just to have a quick look at everything and look at your textbook now, BPP textbook, and to get an idea, so we can proceed from here to the balance part of the work course. So,
which page is in the textbook?
Yeah, just a minute, I'll tell you. This is the ratios.
Performance.
It is in
performance analysis.
Yeah, performance analysis. It is in from page 39 onwards.
Okay. Page
39 onwards, and next week I will be even going to the working capital management. So I will be going beyond page. I will not go to 77. I will go 39, and I think reporting issues. I think I'll be doing reporting issues. I'll send you what I'm going to do it. Yeah. But that's surely 39 onwards, we will be going right up to the accounting ratios, finishing up that one, and cash forecast, all that we will do it. 39 downwards, we'll be really looking. And we will go up to 59, 61, 63 we will be going up next week.
Okay. Okay.
Right. So I'm taking the ratios.
So this is this still part one? This is still under part one, isn't it?
Part one, that's right. Yeah, part one. Yes, I have some more to do on this area. Yes. Yeah.
Okay.
I will do that one because I want to go slow on this area, because I want to get these ratios right into your head.
Yes, sir.
Right.
Very important.
Yeah.
I want to get them into my head.
So yeah, I know.
For my own, because I know they're very important, even for myself.
Yeah.
For my own personal investment. And also for example.
Actually, the next lesson will be very interesting, because we are going to look at the stock market ratios, like the price earnings ratio and all that, which is going to be very relevant and interesting. So we'll look at those things.
Oh, that's great, because I have an interest in stock markets, but I've never really understood it. So this is an opportunity.
Yeah, so we will do that one. Next week we will do it. So Thursday we are meeting with our P3.
Okay.
And
Thursday at 11.
yeah, Thursday 11 we have minted P3. Okay.
Okay. Anything to read for F3 beforehand? Did you say?
P3? P3 or F3? P3, no? Yeah, P3, no? Hello?
Yes, yeah, P3.
Yeah, P3 I think we are going to do corporate governance. Yeah. P3, just a minute. P3, we are going to look at, I think, corporate governance. Yeah, corporate governance. We are looking at the corporate governance on the P3. So,
corporate governance, okay.
Yeah, corporate governance. It's a long session. It will go to over 2 sessions, but we'll be looking at the corporate governance.
Okay.
That is all about the directors and directors' responsibilities and how you as a director, what you have to do all that. So we will talk about those things next Thursday.
Okay.
Okay, Lovette. I'll see you on Thursday.
Okay, thank you.
Thank you. Take care. Bye. Bye.
Okay.
Bye.
Bye.